Welcome to the Deep Dive, your shortcut to getting smart on the latest earnings calls.
Great to be here.
Today, we're digging into the H1 2025 results from Swire Properties. And, well, it's a really fascinating situation, almost a paradox. You see this headline, right? A net loss. Over HK $1.2 billion in the red.
Yeah, catches the eye.
But then you look just a little bit deeper, and their underlying profit, it actually jumped quite a bit, 15%. And the market reaction was, well, pretty muted initially.
Right. Flat price, but more trading volume. So people were definitely paying attention, trying to figure it out.
Exactly. So our mission today is to sort of peel back those layers for you, understand this financial puzzle, and really get at what's driving Swire's strategy and, where they might be heading.
It's that exact contrast, the headline versus the, let's say, the underlying reality that makes this one really interesting to unpack. How can a company report a loss but actually be, fundamentally doing pretty well?
Let's dive right in then, that snapshot. So like I said, Swire Properties reported that net loss, HK $1,202 million for H1 2025, a big swing from a profit the year before. It's the kind of number that makes headlines.
Definitely. Might make some investors a bit nervous if they only look at that.
But, and this is really the key takeaway right at the top, don't let that headline figure mislead you.
No, absolutely not. Because beneath that, the underlying profit, and that's the metric, analysts really watch for core operational health. It surged 15% year over year, came in at HK $4,420 million.
Strong. And revenue?
Revenue was even more impressive, really, up 20% year over year, hitting HK $8,723 million. That significantly beat the consensus estimates by about, HK $1.5 billion?
Yeah.
Solid beat.
Okay, strong revenue, strong underlying profit. And they kept the dividend growing too.
Yep. They declared an interim dividend of HK $0.35 per share. That's the 9th year in a row they've increased it. Shows commitment to shareholders.
9th year. But then back to that market reaction. Stock price didn't move the day after. Volume up 44%, sure, but no price jump. What's the thinking there? Why the silence?
Yeah, it's that priced-in puzzle we mentioned. It suggests the market wasn't totally surprised. Much of the good news, especially around that capital recycling we'll get into, and the strong performance in Mainland China, it seems like it was largely anticipated.
So factored into the price already.
Pretty much. But the higher volume, that shows people were definitely engaging, looking past the headline loss, digging into the details, maybe adjusting their positions. It wasn't ignored, just absorbed.
Okay, so let's unpack that profit picture more. That reported net loss versus the surging underlying profit. Because, for someone maybe not deep in finance, seeing both can feel a bit contradictory. Is there a risk here? Does the gap loss hide anything worrying?
That's a really important question. And the short answer here is probably not. The reported net loss, the gap figure, it was almost entirely driven by fair value adjustments on their investment properties.
Okay, what does that mean exactly?
Think of it like the value of your house on paper. If the market dips, the estimated value might go down, so your net worth on paper decreases. But you haven't sold it. You're still collecting rent if it's an investment property. It's an accounting entry reflecting market sentiment, especially for Hong Kong offices and some mainland properties in this case. It's not a cash outflow impacting their day-to-day business.
Okay, so it's a paper adjustment, not an operational cash drain.
Exactly. Which is why that underlying profit figure, the HK $4,420 million, is so key. It reflects the actual strength of their core operations and the gains from strategic moves.
Got it. But I did notice you mentioned the recurring underlying profit dipped slightly.
Good, Scott. Yeah, the recurring underlying profit, that's the profit from just the regular ongoing business, stripping out things like property disposal gains that did dip slightly, down 4% to HK $3,420 million.
And why was that?
That really points to the known softness in the Hong Kong office market. Rents are under pressure there. But importantly, that dip was partly cushioned by their retail portfolio holding up well and contributions from their U.S. properties before they sold them off. So a bit of a mixed picture on the recurring side, but overall underlying profit was strong.
Right. And that underlying strength seems to show up big time in their cash generation. That looked incredibly strong.
Oh, absolutely. Cash from operations jumped 65% year over year. HK, $6,103 million. That's a huge amount of cash being generated by the business.
That's serious financial power.
It really is. And it connects to another big number, their net cash inflow before financing activities. That surged 420% to HK $6,683 million. Just underscores their liquidity, their financial muscle.
And their debt levels, balance sheet health.
Still very solid. Gearing ratio, which is like a debt-to-equity measure, remains stable and low at 15.7%. That gives them a lot of flexibility. And they actually managed to cut their average borrowing cost, the weighted average cost of debt, down from 4.0% to 3.6%.
Impressive, especially with interest rates where they've been.
Very astute financial management, yeah.
Okay, so this strong cash position, the healthy balance sheet, that seems to be what's enabling their big capital recycling strategy.
Spot on. They're using that strength to actively manage their portfolio. Think of it like pruning a garden to encourage new growth.
How so? What did they prune?
Well, the big one in the first half was selling their interest in the retail and parking garages down at Brickell City Center in Miami, plus a couple of adjacent land plots.
Okay.
That move alone brought in, or recycled, HK $6 billion.
And where does the HK $6 billion go?
Straight into funding their big investment plan. They have this ambitious HK $100 billion 10-year plan. And as of early August, they'd already committed about HK $67 billion of that. So this recycling directly fuels future growth.
And they also bought something in Miami too, right? The hotel.
They did. They bought the remaining 25% stake in the Mandarin Oriental Hotel on Brickell Key, specifically flagging it for potential redevelopment down the line. So it's not just selling, it's also buying strategically to optimize the portfolio.
Smart. Actively shaping the business. And all this feeds back to shareholders how? Through the dividend mainly.
Primarily, yes. That 3% dividend increase to HK $0.35 keeps them on track for their policy mid-single-digit annual growth, aiming for about a 50% payout of underlying profit.
What about share buybacks? They had a program, right?
They did, and they basically completed it 97% executed. But management was clear. Future buybacks aren't automatic. They'll weigh them against other capital needs and market conditions. They're not just going to buy back shares because their competitors are. Dividend growth seems the priority.
Okay, so the internal engine looks strong. Strategic, good cash flow, shareholder friendly. How's it playing out in their actual markets? Let's start with Hong Kong. You said it's a bit of a dual narrative.
Yeah, that sums it up well. The broader Hong Kong office market, still tough. Vacancies high, there's new supply coming, and Swire saw a 5% year-over-year dip in their HK office rental income because of it.
Okay, so the pressure is real.
It is. And this is the crucial bit. Swire's premium assets are really showing their strengths. It's that flight to quality trend.
Meaning?
Meaning top-tier tenants want the best buildings. Look at Pacific Place, 94% occupied. Taikoo Place, the towers are at 91% and 89% occupancy. That's way better than the average for the Hong Kong East area.
So tenants are consolidating into the best properties.
Exactly. And Swire is benefiting. They even mentioned a 30% jump in inquiries for these prime spaces from diverse sectors, finance, insurance, you name it. Companies want well-managed, sustainable buildings, and Swire provides that. It's a real competitive edge.
Okay, so premium offices are resilient. What about Hong Kong retail?
Retail in Hong Kong is actually doing remarkably well for them. Their big malls, Pacific Place and City Plaza, saw sales increase slightly, plus 1% and plus 2%. This was while the overall Hong Kong retail market actually saw a sales decline.
Wow.
Plus, they're running at 100% occupancy in those flagship malls. It really speaks volumes about their ability to create desirable destinations, placemaking. They draw people in even when the overall economy is a bit sluggish.
Right. Strong asset management there. Now, let's shift to mainland China. That seems to be where the big growth story is shaping up.
Absolutely. Mainland China is looking like the growth powerhouse. Their retail properties there saw gross rental income edge up 1% year over year in RMB terms. That might not sound huge, but it's actually outpacing competitors.
And they're investing heavily there too.
Oh, yeah. Big time. They've got major upgrades and expansion plans for their malls in Shanghai, Beijing, Guangzhou, focusing on luxury appeal.
Luxury focus, right.
And you see the impact. They mentioned the Louis Vuitton event, Louis on Nanjing West Road in Shanghai. Apparently, it drew crowds of 100,000 people a day. And that boosted sales significantly in Swire's nearby malls in July.
100,000 people a day. For a store event, that's incredible.
It really shows how retail for them, especially luxury retail in China, is about creating experiences, drawing massive attention.
It seems like a bold bet, though, this aggressive China expansion, given some of the wider worries about the property sector there. Does their luxury focus shield them?
That's the key question, isn't it? And Swire's strategy is quite specific. They're not doing mass market housing across Tier 3 cities. They focus on super prime, often retail-led mixed-use projects, and the very best locations in top-tier cities.
Okay.
They're targeting that affluent consumer who's generally less affected by broader economic swings. That luxury focus combined with their placemaking skill creates a sort of moat around their assets. It does insulate them to a degree from the issues plaguing other parts of the mainland property market.
Makes sense. It's a very specific high-end play. And their residential projects in China are doing well, too.
Yes, the pre-sales for the second batch of units at their Lujiazui Taikoo Yuan project in Shanghai were apparently very well received, fetching high prices. So premium residential is working for them, too.
And the future pipeline in China.
It's huge. They plan to basically double their gross floor area there by 2032. Big projects lined up in places like Xi'an, Sanya, Guangzhou. Zhejiang Phase 1 should complete end of 2025. There's also potential progress on a Sanya Free Trade Zone project. It's clearly the long-term growth engine.
Okay, beyond the financials and the markets, Swire is also making a lot of noise, positive noise, on the sustainability front. ESG, how important is that becoming?
Increasingly critical, and Swire is genuinely a global leader here. It's not just talk, it's becoming a core strategic advantage.
How so? What have they achieved?
Well, they got ranked #1 globally in the Dow Jones Best-in-Class World Index for 2024. Top 1% in the S&P Global CSA score. They're the first real estate developer in Asia Pacific to get an S&P Global Ratings Climate Transition Assessment scored medium green.
Those are serious credentials.
But they are, and it attracts tenants and investors who prioritize sustainability. It's more than just PR. It's about future-proofing the business.
And they're hitting their targets.
Seems so. They cut Scope 1 and 2 carbon emissions by 40% by 2024 using a 2019 baseline. That actually beat their 2025 target. The long-term goal is net zero by 2050.
Wow.
And on the finance side, about 70% of their funding facilities are now green financing, way past their 50% target for 2025.
Right.
They're even partnering with luxury brands like LVMH and Kering on sustainable store design and operations. It's deeply integrated.
Okay, so strong underlying performance, smart capital moves, leading ESG credentials. Let's circle back to that market reaction, the priced-in idea. Why wasn't there more excitement right after the results, given all this? Is the market just waiting?
I think waiting, or perhaps digesting, is right. As we said, all the good news was likely anticipated. But you have to look longer term, too. Swire stock has significantly outperformed the Hang Seng Index over the last 3 months and the last 12 months.
Okay, so the market has been recognizing the strength over time.
Exactly. The flat movement immediately after the results might just be a pause. The market already adjusted somewhat, and now it's looking for the next catalyst, the next proof point.
Right, so what are those catalysts? What should people listening be watching for that might, nudge the stock further or confirm the strategy is working?
Okay, several things. Keep an eye on continued strong sales results from that Lujiazui Taikoo Yuan residential project in Shanghai. That's direct cash flow.
Mm-hmm.
Look for signs of improvement, even stabilization, in leasing and rental trends at their top Hong Kong office properties like Taikoo Place. That would signal the premium end is really holding firm.
Okay, what else?
Progress on the big mainland projects getting approvals. Starting construction in Xi'an, Sanya, Guangzhou. That shows the growth pipeline is moving. Any more strategic capital recycling would also be positive, showing they're still actively managing the portfolio.
And the macro risks.
Always have to watch those. Hong Kong office vacancy overall, consumer confidence in mainland China, and of course where interest rates go. Those hit the backdrop.
Okay, we've covered a lot. The numbers, the strategy, the markets, the ESG angle, really dissected these H1 results. Now, let's get to our This Is Not Financial Advice segment. Time to pitch that outrageous but plausible trade idea.
All right. So, considering everything we've discussed, Swire's strong underlying business, the smart capital moves, the top-tier ESG profile, all against that priced-in market backdrop. Here's the idea.
Lay it on us.
Go long Swire Properties. And at the same time, short a less diversified, maybe more highly leveraged regional developer. Someone in Hong Kong or the mainland who lacks Swire's premium flight-to-quality assets and doesn't have those strong ESG credentials. A pair trade.
Okay, long Swire, short a weaker peer. What's the outrageous part and what makes it plausible?
The outrageous bit is betting that the market will finally wake up and fully reward Swire not just for profits, but specifically for its proactive capital strategy and its sustainability leadership. Basically, betting on a green premium emerging more strongly for them.
So a re-rating based on ESG and strategy, not just earnings.
Exactly. And the plausible part. Well, Swire's track record of outperforming the index is there. Their cash generation is solid. Their investment pipeline is focused on high-growth premium segments. As global money increasingly looks for sustainable leaders, and as Swire's strategy delivers, that re-rating becomes more likely. The moat widens against those weaker peers you're shorting. It's betting on quality winning out, perhaps faster than the market currently expects.
A compelling thesis. So wrapping up, we've really seen Swire Properties navigating a tricky environment pretty skillfully, haven't we? Using that capital recycling, focusing on high-quality, sustainable projects in key growth areas.
Yeah, the H1 2025 results, despite that headline loss, really paint a picture of a fundamentally strong business with quite a bit of future potential baked into its strategy.
Definitely food for thought. Now remember, everyone, this deep dive is purely for informational purposes. It is absolutely not financial advice.
Please do your own research before making any investment decisions. Due diligence is key.
But we'd love to know what you think about Swire Properties. What stands out to you after hearing all this? Let us know. Join the conversation.